it should be a risk-reward story, but the fact is that this has been a risk and risk story because there really hasn't been any reward for the risk.
Welcome to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mancell, founder of Mancell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on the S&P ASX Small Ordinaries Index, which some investors may know is tracked by Blackrock iShares ISO ETF and State Street's SSO ETF. The index is designed to measure companies included in the S&P ASX 300, but not in the S&P ASX 100. And it's about 10 to 12% of Australia's equity market. So we're taking a look at this because it has been a long-term struggler against larger companies, and it raises the question about any exclusive small cap effect in Australia. Your Investment Philosophy, a book we wrote, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make a step to sign. These are simple concepts. We'd like investors to better understand risk so they can make informed decisions. Quite a busy page, but on top of the small odds returns, then the 100, 200 and 300 index dropping down below. I don't believe there are any ASX 100 tracking products. I'm happy to be corrected there, but you can see what's happening by including 100 smaller companies to the ASX 100. It becomes a drag on returns. Then you add another 100 to the ASX 200 and it's further drag on returns. And those combined 200 companies are the small ordinaries.
Yeah, it's an interesting experience that investors have seen over, that period of 45 years, whereby companies that have found their way into the top 200 and some companies that have found their way into the top 300 that have ended up failing or performing particularly badly have actually dragged down the average return experienced by investors that just held the top 100. If we particularly look at stocks 200 down to 300, I can say with confidence that there's been a strong prevalence of second and third tier mining companies that have enjoyed short-term support, inverted commas, boom, that then allowed them to go into those indices only to see those mining operations subsequently fail in the ensuing period. But there have also been stories of other non-mining companies that have managed to find their way into the top 200 that have also proved to be a lag on the 100. An example of that we both well know because we live in Tasmania, a company by the name of Guns all but made it to the top 100. But eventually, through greed, poor management, lack of prudence, the company went broke. It took massive risks and ultimately those risks were not rewarded.
And calendar year returns, obviously this is a fairly basic thing to do, but one of the things you usually see with factor outperformance is it may trail off for a while, but not substantially. But then you have these periods of significant outperformance which give the investor some sort of payoff for remaining patient. And here there's just absolutely no evidence of it.
No, the Australian market, when it comes to small companies, because of the issues that I mentioned just a moment ago, and particularly the second and third tier mining companies that for short periods manage to sort of sneak into those ASX 200 and ASX 300 indices, is a relatively unique phenomena across the world. In larger markets, and remembering Australia is a very thin, small proportion of the global public equity markets. The smaller companies in Europe, in North America and the like don't tend to be as biased towards mining companies as here, and the small cap effect in all other developed markets is certainly evident over long periods of time. But here in Australia, 45 years looking backwards, not the case.
I've also circled the 87 crash because small was ahead for most of the 80s, then got sort of yanked back and overtaken by the ASX 100. But it's probably important to note here that from 1980 until December 1990, the ASX 100 was the ASX 50 Leaders Index, and the Small Ords was the ASX X50 Leaders Simulated Index. Setting aside any simulation, the construction of these two indices were weighted slightly differently when the Small Ords was performing quite well in this period in the 1980s.
Look, the key comment that I'd make about that, and I'm lucky to be able to look back with hindsight, that's effectively the first 10 years of my career in financial advice. Second and third tier mining companies were being bought by everybody on the speculation that they were going to pick the next big winner. There were some colourful characters, promoting mines that had identified great new ore bodies of gold and nickel and platinum and the like, and investors just literally threw money at them, and share prices escalated dramatically and ultimately collapsed. Companies back in the day like Poseidon, Tasmanex, although I have to admit they were in the 1970s prior to this, where investors just got absolutely passionately keen on the wonderful riches that were going to come out of those mines. But the end result was it didn't eventuate. As you'd expect, look, the range from best to worst in the first year is wider than it is for the broader market. That's to be expected if you're investing in a more volatile asset class. Even the ranges as we go out, through 3, 5, 10 and 20 years are certainly wider than the broader indices. It should be a risk reward story, but the fact is that this has been a risk and risk story because there really hasn't been any reward for the risk.
You made the point there about the run up into 87 too. You can see the best 3 years starts back in 1984 and you know pretty much where it's going to end.
I just remember so clearly, mining stocks being just decimated. I can remember there was a fund manager of the day that no longer exists by the name of Clayton Robard, and they had a Clayton Robard Gold Fund, they had a Clayton Robard Special Situations Fund, they had their standard flagship Australian share fund. But when you look through the actual portfolio lists, there weren't quality companies there. There were lots and lots of speculative purchases that saw prices decimated. I recall the Clayton Robard Gold Fund in the month after the 1987 crash had lost something like 90% of its value. That was a clear indicator that investors were taking risks that they really didn't understand. The underlying businesses that were being purchased did not have reliable business models, and the poor old investors suffered badly.
The rolling annual returns, as we're doing a comparison of the ASX 100 here, the small falls are larger. There are periods of losses where the ASX is positive.
One of the key messages is the prevalence of the below the line components of the chart are much more pronounced than in a broader index, or certainly than in the Australian large cap index.
Rolling 10-year return. So as noted, this is 421 10-year periods since 1980. Small Ords wins 24 times, and it's a period ending in 2011, 2012.
It's a clear indicator that whilst small cap research around the developed world does show the long-term returns have a premium in them, Australia has been a standout that doesn't fit that framework. It's been a significant laggard, and one that I think that, particularly because we have such a narrow market with such a concentration, investors need to be very cautious about.
And largest fall in time to recovery. So severity down at 60%, and duration is pushing at 12 years, and at a guess, plenty of various short-lived resource booms and busts in this period.
Look, the period from peak to trough and back to peak is very similar to the broader indices, but the depth of the worst of the fall is marginally worse. And to your point, the mining industry per se has very much been about managing booms and busts.
A risk return or efficient frontier in the small ords is exactly where you don't want to be, far to the right of the chart, mid or nearing the bottom. Over this time frame, it's a fixed interest like return with a higher volatility than REITs.
Absolutely not in line with Harry Markowitz's efficient frontier works, but it does actually remind me of a comment from Ken French in a conversation I had with him about probably 15 years ago now, that a risk that you can diversify away is not a risk that has to be rewarded. And the simple fact is that the concentration of second and third tier mining stocks can be diversified away more broadly across the globe. So there's no reason that ours actually have to be the ones that get rewarded.
And sources and descriptions of data. So thanks for your time.
Bye for now.